Financial reporting. Chapter 1, Chapter 2, we have covered so far. We have covered some accounting standards. We have covered IAS 16, property, plant, and equipment. We have covered IAS 23, borrowing cost. We have covered IAS 40, investment property. What else we have covered? Government grant IAS 20. So in Chapter 2, we have covered 4 accounting standards: IAS 16, IAS 20, government grant, IAS 40, investment property, and IAS 23, borrowing cost. So let's move towards Chapter 3, that is based on intangible assets. Chapter 3, intangible assets. Our non-current assets are of 2 types. So non-current assets are of 2 types: tangible non-current assets and intangible non-current assets. Tangible, that have physical substance, in that physically exist, that we can touch as well as see. What are those? Land and building, plant and machinery, motor vehicles, furniture and fixtures that have physical substance. The other type of non-current assets are intangibles. Intangibles mean that it does not have a physical substance. We cannot see or touch them. What are those? Goodwill, patents, copyrights, trademark, license, development cost, grant. That does not have a physical substance except development cost. How is grants? We're gonna discuss. So these are the examples of intangibles. Tangibles, land and building, plant and machinery, motor vehicle, furniture and fixtures. Intangibles are goodwill, patents, copyrights, trademark, licenses, development cost, and brands. What is goodwill? What is goodwill? Extra amount paid over that asset. Value of a business due to its repute. In common words, we can say value of business due to its repute. Suppose I am having a business. This is my business. What business is that? I'm running an institute. I'm running a college of accountancy. I'm running this college of accountancy. In this business, in this college, I'm having some assets. Suppose I am having a land and building of say 40 million. I'm having some furniture, say 10 million. I'm having some motor vehicles for student pick and drop, that is say 10 million. I'm having some other assets as well. For this business, I'm having total assets, say 60 million. What is this? Total assets, value of total assets. So value of my asset is a 60 million. And this college is running excellently. I'm attracting so many good students. We are producing good results. Our college repute in the market is excellent. I'm generating huge revenue. I'm earning super normal profit from this business. The value of my business asset is 60 million. An investor offered me, I want to buy this college in 80 million. He knows my asset value is 60 million. But he want to pay 80 million for this college. This means he is paying 20 million extra. That 20 million, why he is paying? Due to repute of the business. So that will be called goodwill. So we can say, what is goodwill? Goodwill is the difference between consideration paid that is what he is going to pay 80 million, and fair value of net assets acquired. In how many net assets he is going to acquire from my business, that is 60 million. So that 60 million will be called fair value of net assets acquired. Fair value means market value. In fact, active market value, not market value, active market value of net assets acquired. Net assets acquired means assets minus liabilities. Active market price means market price in the market where these assets are traded. Active means the market where these assets are trading. So that market price will be called active market price. If your type of asset is not trading in the market, then you can take market price, not active market price. Active market price means a market where similar assets are trading. So if you can find active market, you should find active. If there is no active market, like you are having a unique type of asset, then you will take market value. So what is goodwill? Difference between consideration paid and fair value of net assets acquired. Suppose investor have bought this college. In his balance sheet, he will record these assets with the same value. Land and building, 40 million. Furniture, 10 million. Motor vehicle, 10 million. But he has paid 80 million. So remaining 20 million, he will show in his balance sheet as goodwill. Mean only purchase goodwill should be recorded as intangible asset. We are having 20 million our repute of business, but we cannot record this as goodwill in our balance sheet. Internally generated goodwill will not be recorded as intangible asset, mean will not be capitalized. Capitalized means recorded as asset. Only the purchase goodwill should be recorded as intangible asset. Because your business repute you have generated in the market is not because of any single element. There are so many elements. Might be you are having a good teachers. They are delivering vast services. That's why your repute have been created. Might be you are having a building at attractive place that is easy for student to access. Might be your repute has been created due to that. So you cannot record internally generated goodwill as asset. Only purchase goodwill will be recorded as asset, mean intangibles. Is that fine? Mean if you have bought any business and you have paid over their assets, so the amount paid over their assets you will record as goodwill. If you have built up your goodwill by yourself, you cannot record them as asset. Is it fine? What are the other intangibles? Patents. What is patents? What is patents? Copyrights, licenses, trademark. We have paid to any business, like we will use your name. Like we have bought a franchise. We have paid to Pepsi, like we will produce Pepsi by ourselves and we will sell. And we are paying to Pepsi every year. So that is purchased patents, copyright, trademark, or license. So we'll record as intangible asset. What is development cost? We will discuss later on. What is like how will Pepsi record its own copyright? Pepsi will not record its intangible. We will record as intangible because we have bought, we have a paid amount for this. If you have created by yourself, then you will not record as asset. Only purchase will be recorded as asset. Oh. What is brand? What is brand? Brand, like we are using our logo of like this shape on our product. And this logo is of particular brand that we are using on our product, and the customer having a perception they are buying that brand product from you. And if we have a pay to that brand by using their product on our product, so that will be intangible asset. If we have created this logo from our business itself, that is internally generated. So internally generated brand will not be capitalized, only purchased brand should be capitalized, mean recorded as asset. Capitalized mean recorded as asset. Internally generated cannot be capitalized. Similar, similar thing. Like you copyright patents, like you are producing certain goods according to the formula of other company that you have bought. While brands mean you are using their logo. Manufacturing by yourself, but putting their logo on your product. Putting it certain almost similar thing. Patents, copyrights, trademark, licenses, brands, almost same thing. But only purchase should be capitalized, where you have a made payment, you will record as intangible. Internally generated cannot be capitalized. And where will put it? Under non-current assets, first we will record tangible, and then we will record intangibles. Where? Statement of financial position, balance sheet. So non-current assets are of two types, tangible and intangible. Tangible non-current assets. There is accounting standard on tangible non-current assets, that is IAS 16, property, plant and equipment. And IAS 16 says property, plant and equipment should be depreciated over their useful life. Mean for tangible non-current assets, we need to record depreciation in the financial statement. How to calculate depreciation? There are two methods. We can calculate using straight line method. We can calculate using reducing balance method. Intangibles, we need to depreciate as well over their useful life. But the word depreciation is changed to amortization. Intangible will be depreciated, while intangibles we need to amortize. The calculation pattern is same. And if the asset life is 10 years, we will divide the cost by 10 years and we will charge amortization every year. Only the word depreciation is a change with amortization, otherwise concept is same. So intangibles need to be amortized over their useful life. Is it fine? So it's a non-current asset. Tangible non-current assets should be depreciated over their useful life. Yeah. Intangibles should be amortized over their useful life. How we calculate? Suppose asset life is 10 years. Cost is 100,000. Every year, how much amortization we need to charge? 10,000. Is it fine? One thing more. So intangibles we need to amortize. Goodwill will not be amortized. No amortization is allowed on goodwill. Why? We cannot estimate useful life of goodwill. Goodwill life cannot be determined. Goodwill life cannot be determined. Trademark, copyrights, licenses we have obtained for 5 years, we have obtained for 10 years. Life is determined. But goodwill, your repute might be lost very next day. So its life cannot be determined. That's why goodwill is excluded from amortization. There will be no amortization of goodwill. And intangibles, those who are having indefinite life, like brands, is having indefinite life, so will not be amortized. So intangibles should be amortized, but goodwill is excluded from amortization, and intangibles having indefinite life. Indefinite mean till forever they will continue. So their life we cannot estimate is how many years. So they will not be amortized. But goodwill should be impaired. What is impairment? At every year end, we need to check the goodwill carrying amount. Carrying amount means in the books, in our financial statements with market value. Like what is the worth of our brand now? And if according to market information, we are aware that our business worth is going down, our repute is going to be affected in near future, then we need to reduce the value of goodwill. And that will be called impairment loss, where it should be recorded in profit and loss account. So goodwill should not be amortized, but there should be impairment test performed on goodwill every year. Impairment means comparing value with market value. And if market value is lower, we need to reduce the goodwill amount. And the reduction in amount in asset is crediting. So what is debit? Profit and loss account, impairment loss, impairment expense. Not only goodwill, all intangibles we need to perform impairment test. Not only intangibles, all asset, either tangible, either intangibles, we need to perform impairment test. How we will discuss in next chapter. Next complete chapter is on impairment. We are just familiarizing with a word called impairment. Impairment means reduction in the asset value due to market. Can impairment increase the value? Impairment cannot increase the value. If market value is higher. That is called reversal of impairment. We will discuss in next chapter. And it is a must every year for all assets, all non-current assets. For goodwill, it is must. Goodwill it is must. And for assets where we are not charging amortization, it is must. Every year end, we need to perform impairment review. We need to check their market value at year end because we are not amortizing them. So we need to perform impairment must. If any asset we are amortizing, we are depreciating, impairment is not a must. If there is a need, we should charge impairment. If there is no need, we shouldn't charge. We'll discuss impairment in next chapter. Next complete chapter is on impairment. So intangibles, what are intangibles? Internally generated cannot be capitalized, only purchase should be capitalized. And intangibles should be amortized over their useful life. Goodwill should not be amortized, but must have impairment review every year end. An intangible asset having indefinite life should not be amortized, but impairment test must be performed every year. In all intangibles, if there is a need for impairment, Either we are amortizing, if there is need for impairment, we need to impair as well. Let's move forward. Regarding development cost, we will discuss things later on. Let's read few lines. An intangible asset is an identifiable non-monetary asset without a physical substance, meaning no physical existence. Intangible asset include license and quotas, intellectual property, patents, copyrights, brand name, trademark. And for an asset to be identifiable, IAS 38 mean intangibles. Accounting standard is IAS 38. Tangible property, plant and equipment, IAS 16. Intangibles, accounting standard is IAS 38. It must fall into two categories. It is separable. The asset can be bought or sold separately from the rest of the business, or it arises from legal contractual right. This will arise as part of purchasing an entity company. Intangibles could be separate asset or could be part of purchasing company, mean goodwill is part of subsidiary. Purchasing company means subsidiary. It must also meet the normal definition of an asset, mean either tangible, either intangibles are resource controlled by the entity as a result of past event. Either we have constructed or we have bought. Enforceable legal rights, mean companies having legal rights. It's a company resource, a resource from which future economic benefits are expected to flow. I mean, what is the purpose of asset? To provide benefits to the business, to generate revenue. What's the purpose of assets? To generate revenue, to provide benefit to the business, either in parts of production, either in sales revenue terms. I mean, due to this, either we are saving cost or we are increasing revenue. Saving cost, increasing revenue, both will provide benefit to the business. Recognition. So we need to recognize as asset in balance sheet if they are meeting criteria of asset, and purchase tangible assets if an intangible asset is purchased separately, such as license, patents, brand name. It should be initially be recognized at cost. But there are two models on which we can recognize intangible asset, either on cost basis. Cost basis means cost less amortization, or revaluation basis. Revaluation basis means at every year end, we need to compare carrying value with the market value. And if we are moving towards revaluation basis and market value is higher, we will record revaluation surplus, where under statement of comprehensive income, if market value is lower than carrying value, there is revaluation loss, and loss should be charged to profit and loss account. Is it fun? So the cost model, the intangible assets should be carried at cost less amortization and any impairment losses. This model is more commonly used in practice. Why? Because there are certain intangibles and their market value cannot be determined. Brand, your brand recognition. What is market value? If your brand is a unique type, there is no similar brand in the market, so you cannot check its market value properly. So that's why they are normally classified, accounted for using historical cost basis rather than revaluation basis. Amortization work the same as depreciation. The intangible assets is amortized over the useful life, which the annual expense being shown in statement of profit or loss. I mean, where amortization should be recorded in profit and loss account rather than comprehensive income. And intangible assets with the finite useful life must be amortized over their life, normally using the straight line method with a zero residual value. I mean, normally intangibles are amortized using straight line method, not reducing balance method. An intangible asset with indefinite useful life should not be amortized, but should be tested for impairment annually, and more often if there is an actual indication of possible impairment. The revaluation model, if we have chosen, ultimately the gain we will record to revaluation surplus, the losses should be charged to profit and loss account, and we need to amortize over the revalued amount. Internally generated intangible assets, generally internally generated intangible assets cannot be capitalized. Why? Because their value cannot be separated from the business. Mean their value cannot be determined properly until somebody offer any price, you cannot calculate its value. As the cost associated with these cannot be identified separately from the cost associated with running the business, the following internally generated item may never be recognized, may never be recorded as intangibles: internally generated goodwill, internally generated brands, mesh ads. What is mesh ads? Newspaper article. If you are publishing any newspaper, any business journal article, and you are publishing that article from last 10 years, and that article name or slogan repute is high in the market, mean people normally try to study those article on regular basis. So that is called intangible, but will not be capitalized because it is internally generated. Publishing titles, same like articles, and a customer list, like you are having a customer data. Obviously, that data you are using for marketing purpose is having a worth, is having a value. But as you have generated by yourself, if you bought from someone other company, that you can capitalize. But internally generated, you cannot capitalize. Brands. The accounting treatment of brand has been a matter of controversy for some years. 2 years back, internally generated brand could be capitalized if their value can be determined. But now they have cleared internally generated brand will never be capitalized. Only purchase brand should be capitalized. So IAS 38 tangible assets now has ended the controversy by stating that internally generated brand and a similar asset may never be recognized. Expenditure on internally generated brand cannot be distinguished from cost of developing the business as a whole, so should be written off as income. Where a brand name is separately acquired, mean purchased brand, can be measured reliably, then it should be separately recognized as an intangible asset and accounted for in accordance with general rule of IAS 38. We need to charge amortization as well as impairment. Goodwill. The nature of goodwill. Goodwill is the difference between the value of a business as a whole and the aggregate of a fair value of its separable net assets. Mean consideration paid minus fair value of net assets acquired. Separable net assets are those assets and liabilities that can be identified and sold off separately without necessarily disposing of the business as a whole. And they include identifiable intangible assets such as patents, license, and trademark as well. Mean net value of fair value of net assets acquired include tangible as well as intangible assets. And fair value is defined by IFRS 13 as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants as the measurement date. Mean what does mean by fair value of asset? Market value, market price. Like if you sell those assets in the market, what you can receive. So that is called market value, mean fair value. Goodwill may exist because of any combination or a number of possible factors in why goodwill created. Due to repute for quality of services, due to technical expertise your business is having. That's why somebody is paying extra more than your business assets. Possession of a favorable contracts, mean you are having bigger customer, you are having contract with bigger customers, and those contracts are long term, like your business is generating long term revenue. Are good management and staff, are your staff, your management is excellent. That's why somebody want to pay more than your asset, because they are requiring expertise. Purchased and non-purchased goodwill. Purchased means if you have bought any subsidiary, and while buying subsidiary, you have a paid over their net assets, so that will be called purchased goodwill. What is non-purchased? Internally generated. So only purchased goodwill should be capitalized. Non-purchased means internally generated should not be. So goodwill is defined as an asset representing the future economic benefit arising from asset acquired, mean through subsidiary. It is arises in a business combination that are not individually identified and separately recognized. And accounting for non-purchase goodwill should not be capitalized. Now moving towards development cost. So IAS 38 cover intangibles, and IAS 38 covers research and development cost as well. Research and development cost. What is research cost? What is development cost? Research cost, according to IAS 38, research cost should be expensed out. It should be recorded as expense where in profit and loss account. Cannot be capitalized. Development cost can be capitalized, but if meeting a certain criteria. If it is not meeting a criteria, it should also be expense out. What is that criteria? That criteria is the 6 criteria. Technical, feasible, commercial, viable, intention to use, complete, or sell, ability to use, complete, or sell, availability of resources, and amounts can be measured reliably. Cost can be measured reliably. What does that mean? We're gonna discuss. If development cost meeting these 6 criteria, it should be capitalized, mean recorded as asset. If any one of these criteria is not fulfilled, development cost should be expense out. And if we have capitalized development cost, it should be amortized as well as should have impairment review. So according to IAS 38, research cost should not be capitalized, it must be expense out. Development cost should be capitalized. Capitalized where? Statement of financial position recorded as asset under intangibles, but if meeting these criteria. So let's distinguish between what is research, what is development, and then we will discuss these 6 criteria. Suppose we are going to develop a corona vaccine. We are going to develop a vaccine for corona. What we need to do for developing vaccine for corona is that straightway we will start producing corona vaccine? No. First, we need to find the formula. We need to find some material. We need to find some source through which we can produce corona vaccine. This means before producing vaccine, we need to perform some experiments. We need to investigate certain people. Like, what are the things that can be used in producing corona vaccine? We need to consult some scientist. Then we will be able to find a formula or sort through which we can produce corona vaccine. We need to make investigation, we need to perform some experimentation, and we need to perform some consultation with the expert scientist. Then we will be able to develop a formula or salt, or you can say we will be able to develop a sample. That sample is also called prototype. If we have just performed investigation, how we have performed investigation, we moved different location, we discussed things with different people, and we spent some expenses. We have performed some experimentation. On experimentation, ultimately we are spending some money. We have consulted different scientists. Obviously, scientists will not give us time in free, they will charge us. If we have just performed only the investigation, experimentation, and consultation, but haven't developed any formula, haven't developed any sample, so that cost will be called research cost. You have performed investigation, you have performed experimentation, you have performed consultation, and you spend so many amount. But you haven't developed any formula, you haven't find any sort, you haven't developed any prototype mean product. So that cost is called research cost. But if after performing investigation, experimentation, consultation, you have developed a formula, salt, sample, or prototype mean products, so that will be called cost. Without developing anything, the money spent is called research cost. And if you have developed something, so that will be called development cost. Now you can capitalize. If you haven't developed anything and wasted money, wasted time, so that is research cost, all the money spent should be expense out, should not be recorded as asset. Because only investigation, experimentation, consultation without developing anything is not providing you future benefits. You can get future benefits through any formula, through any sort, through any sample, through any prototype, through any product, through any activity, through any process that you have developed for cost reduction in your business. So can you differentiate between research cost and development cost? So research cost should be expense out, development cost should be capitalized, but only if a development cost meeting these 6 criteria. Technical feasible. What does that mean? Realistically, you can develop any product. How? If you have developed any sample or prototype, this means you can develop further more products. If you haven't developed any prototype or sample, mean you are just having a formula, but haven't developed any prototype or sample, this means it is not technical feasible. If through that formula there are some products existing in the market, you can also produce, it is technical feasible. Technically, you will be able to produce something through that formula, through that salt. If technically you will not be able to develop anything, this means this criteria is not meeting, that will be expense out. Commercial viability. Commercial viability mean your product must be having a demand in the market. You will be generating some revenue from the market. If there is no demand in the market, there is no customer for your product, it is not commercially viable. It will not provide benefit for your business. It should be expense out because it's not commercially viable. There is no demand, there is no customer, you will not generating revenue. Intention to use, complete, or sell, it is management intention. They are willing, okay, we're gonna use this product in our production process as a material. We're gonna complete this, and by after completion, ultimately we will use, get some benefit, or we can sell in the market. If management intention is not there, their willingness is not there either to use, complete, or sell, this means this is useless thing, expense out. Not only management intention is there, their willingness is there. There should be ability to use, complete, or sell. Ability mean you should have a people, you should have machinery to produce that thing. And you must have resources, especially financial resources mean money for marketing, for developing, etc. If you don't have money, you cannot produce, you cannot market. So this will not provide you future benefit. And the amount you need to capitalize as asset, that amount is realistically measured. If that amount is based on guess, in this material could be of 10 million, in this labor could be of 5 million, in this overhead could be of 7 million, could be. That are not realistically measured, so you cannot capitalize any amount. The amount you need to record as asset, that should be realistically measured based on some actual data, rather than everything is forecasted. So if development cost meeting this criteria, it should be capitalized. If not meeting any one of the criteria, it should be expense out. And once you have expense out any amount because it was not meeting criteria, the next time might be that amount meeting criteria. So you need to capitalize only the next time amount, not the previous. And this criteria you need to check every year for development cost. Suppose in first 2 years, development cost was meeting criteria. In third year, it is not meeting criteria, expense out. It will not remain as development cost. Okay, let's see. Research is original and planned investigation undertaken with the prospects of gaining new scientific knowledge and understanding. What is this? Investigation mean experimentation, consultation. Development is the application of research finding. Mean after performing investigation, consultation, experimentation, now you are moving towards developing something or other knowledge to a plan or design, develop for the production of new substantially improved material, devices, products, process, system, or services before the start of commercial production or use. Mean either you want to use it inside the business or you want to sell it outside the business. Are definitions important for the exam? Just for understanding. They don't ask. They don't ask to produce the definition, no. They might be write a line and ask you whether it is meeting the definition or not. Accounting treatment research cost, expenditure, write-off, mean expense out, where profit and loss account. And development expenditure recognized as intangible asset. If and only an entry demonstrate the following criteria. What is falling criteria? Probable flow of economic benefit mean commercial viability. Intention to complete use or sell. Cost can be measured reliably. Adequate resources are there. It is technical feasible and expected to be profitable. Mean your ability to sell this product to generate revenue. In simple words, technical feasible, commercial viability, intention to use complete, ability, availability of resources, and cost can be measured reliably. And development expenditure should be amortized over its useful life as soon as commercial production begins. What does that? In this year, you have developed something. So you will record as intangible asset development cost. But suppose the production will start by using that formula in the next year, or you will sell product in next year. So amortization will start from next year, not from this year. Depreciation will start when the asset is ready for use. Amortization will start when commercial production begins. Question understanding one. Good luck, everybody. How should each of these costs be treated in the financial statement of entity? Whether they should be recorded as asset or expense. An entity has incurred the following expenditure during the current year. Part A, 100,000 spent on the initial design work of a new product. Initial design work. It is anticipated that this design will be taken forward over the next 2-year period to be developed and tested with a view of production in 3 years' time. You have just performed designing cost, haven't developed anything, you haven't produced anything. So this will be recorded as research cost expense out in profit and loss account. Part B, 500,000 spent on the testing of new production system, which has been designed internally, developed, designed something, and which will be in operation during the following accounting year. This new system should reduce the cost of production by 20%. And if you have designed something, so that will be development cost should be capitalized in the current year, but amortization should be charged from the following year when production will begin. That's your understanding too. Explain the accounting treatment for the above issues. Number one, a brand name relating to a specific range of chocolate bars purchased for 200,000. By the year end, a brand specialist had valued this at 250,000. To purchase brand, we should capitalize as intangible with how much amount? 200,000 initially. But at year end, if its market value is 250, the 50,000 we should record as revaluation surplus if a business choosing recording on revaluation basis. If business choose cost model, then it should be recorded as 200,000 and should be amortized over its useful life. Because 250 we can record if we have adopted revaluation. And it is purchased, we can capitalize. Number two, 500,000 spent on developing a new line of confectionery, including 150,000 spent on researching the product before management gave approval to fully fund the project. So 150 is the research cost because might be after spending this cost, management doesn't approve. So this should be treated separate as research cost and it should be expense out. And out of 500, if we deduct 150, remaining 350 should be recorded as development cost and should be amortized over its useful life. Training costs for staff to use a new manufacturing process. The total training cost amounted to 100,000 and staff are expected to remain for an average of 5 years. They are saying we have spent some 100,000 for staff training to make them mature. And through this, we will retaining the staff for next 5 years. Can you retain anybody in the organization? And for 5 years, because we have trained them. Oh, if you have trained them, they will be seeking more opportunities in the market. They might be leaving very next day. So that doesn't mean it providing future benefits. So it should be expense out. It should not be recorded as asset. Because this is not a resource controlled by the entity. Means staff, you cannot control. They are human beings, not machines. Illustration 2. Improve has deferred development expenditure of 600,000. Development cost of 600,000 relating to the development of numerical brand 10. It is expected that the demand for the product will stay at a high level for the next 3 years. Annual sale of 400,000, 300,000, and 200,000 units respectively are expected over this 3-year period. Brand X sells for $10. How should the development expenditure be amortized? How much is the cost? 600,000. How many years? How many years they will provide benefit? For 3 years. So there are two treatment of charging amortization. One, 600,000 divided by 3 years mean charge 200,000 every year. Other is using pro rata basis. Mean in first year it will provide you benefit of 400, in second year it will provide you benefit of 300, in third year it will provide you benefit of 200. How much is the total benefit in 3 years? 4 plus 3, 7 plus 2, 9. So what you can do in year 1, you can charge amortization. The total cost is 600,000. Multiply by how much is the benefit you are generating, 400,000 out of how much? 900,000. So you can charge in year 1 like that. In year 2, you can charge 600,000 into how much benefit? 300,000 divided by 900,000. So you will charge this amortization in year 2, and for year 3, it will be 200 by 900,000. Both treatment are acceptable. In according to benefit, you can charge amortization, or you can charge amortization straight line method, same everywhere. Both treatments are acceptable. Test your understanding 3. Question number 1 of test your understanding 3. Types. How should these costs be treated in the financial statements of Cowper PLC for the year ending 31st December 2020? Cowper PLC has spent 20,000 researching new cleaning chemicals in the year ending 31st December 2020. So this should be charged as expense, profit and loss account. They have also spent 40,000 developing a new cleaning product, which will not go into commercial production until next year. And the development project meets the criteria laid down by IAS 38, meeting the criteria. So 40,000 should be charged as development cost, but amortization should be charged from next year. No amortization should be charged in current year. So option A, 60,000 should be capitalized. No. B, option 40,000 should be capitalized as an intangible and should be amortized. No. Amortization will start from next year. 40,000 should be charged as an intangible and should not be amortized. Yes, 20,000 should be written off. Number 2. Which two of the following item below could potentially be classified as intangible asset? Purchase brand name, training of staff, internally generated brand, licenses and quotas. Number 3. The requirement, which of the following adjustments will be made in the financial statement as at 31st December 2026? What adjustment is required in financial statement? What should be recorded as expense? What should be recorded as asset? And there are 3 projects A, B, C. So for project A, 50,000 has been spent on research phase. It should be charged as expense in profit and loss account. Project B, 80,000 had been spent on this project in the previous year and 20,000 this year. The project was capitalized in the previous year. However, it has been decided to abandon this project at the end of the year. So complete 100,000 should be expense out. Project C, 100,000 was spent on this project. This year, the project meet the criteria of IAS 38 and is to be capitalized. So this should be recorded as asset. What are the options? Reduce profit by 70,000. No, reduce profit by 50 plus 100,000, 150. Not 70. Yeah. You know? Because that 80,000 is recorded as asset that we need to expense out now. So reduce profit by 70,000 and increase non-current assets by 100,000. Non-current assets should be increased by 100,000, but profit should not be reduced by 70, should be reduced by 150. Reduce profit by 150, yes, and increase non-current assets by 20,000. No. Reduce profit by 130 and increase non-current assets by 180. Reduce profit by 150 and increase non-current assets by 100,000. Yes.
Can you explain again why it's 150?
Why is 150? Is 50 and this?
80 was also previous year.
That is recorded as asset. How you can eliminate it?
Okay, so you're removing it now.
Yeah, this.
Asset credit, where you will record the debit expense. You know?
Yeah.
Number 4. Which of the following statement concerning the accounting treatment of research and development expenditure are true in accordance with IAS 38? Research is original and planned investigation undertaken with the prospect of gaining new knowledge and understanding. Yes. Development is the application of research finding. Yes. Depreciation of plant used specifically on developing a new product can be capitalized as part of development cost. Yes, if any asset is using in research and development, its depreciation will be capitalized in development cost rather than charging as expense, because that asset is used where in this research and development. Expenditure once treated as an expense cannot be reinstated as an asset. Number 5. Which of the following should be included in company's statement of financial position as an intangible asset under IAS 38? Internally developed brand? No, cannot be capitalized. You cannot separate their value from the business. Internally generated goodwill? No. Expenditure on completed research?
No.
No, that should be expense of research. Payment made on successful registration of patent? Yes, payment made. Number 6. You need to calculate the value. Use your calculator to calculate the value. And from next class, I need a calculator in your hand while sitting in the classroom, not mobile. Otherwise, you will see mobile is going out of class window. In the similar manner, honor is also falling in. And that calculator that you're gonna use in your exam paper. In exam paper, you will not be allowed to use mobile calculator. So that you can have a good grip on calculator, how to use calculator quickly. So try to use calculator in your routine. During the year to 31st December 2008, X company incurred 200,000 of development cost for a new product. In addition, X company spent 60,000 on 1st January 2008, at start of the year, on machinery specifically used to help develop the new product, and 40,000 on building the brand identity. Commercial production is expected to start during 20X9. No amortization. The machinery is expected to last 4 years with no residual value. What value should be included within intangible asset? In respect of the above in X company statement of financial position. So this should be capitalized 200,000 and 60,000 machinery is used, but we need to include its depreciation. What is total cost? 60,000, 4-year life. What is the depreciation per year? And 40,000 on building the brand identity. This is internally generated.
But the 50.
The machinery used in developing any product, its depreciation should be capitalized in development cost, intangibles. So that machinery is specifically used for this development of product. Its depreciation for the year will capitalize as asset intangibles. Number 7. Which two of the following criteria must be met before development expenditure is capitalized? According to IAS 38. The technical feasibility of completing the intangible asset, technical feasible criteria was there. Future revenue is expected. Technical feasible, commercial viable, ability to use computer cell, intention, availability of resources, cost. The intention to complete and use our cell. There is no need for reliable measurement of expenditure. No, there is a need. So what are those two criteria, A and C? Even if we see B, revenue are expected, mean commercial viability, but mainly that is relating to demand in the market. Most appropriate A and C. Number 8. For each issue, identify the correct accounting treatment in Matira's financial statements. 1, 2, 3, 4, whether they should be recorded as asset or expense. Agree? All agree? Okay. This chapter is completed, except one part. This question number 3. Can you cover it again, please? Using common sense as well. Just read the requirement A, B, C, D, and then see what should be the correct option. We marked D first, but that is wrong. No. Don't say then C. Say no. Not A, not a D. How many senses are there? 5. What are those? Touch, smell, taste, hear, sight. There is 6 sense. Nonsense. That normally doesn't work during exam paper due to exam pressure. There is 7 sense as well. That is nonsense. Okay. Profit should be reduced by 150 because we need to record expense of 50 and 100. If you see number 2, in your asset, what was there before 80,000? 20,000 was not recorded as asset. It's incurred during the year.
Yeah.
We haven't recorded that. So 80,000 asset was already there. Now you need to record a new asset of 100,000. This means 80 was already there that you need to eliminate. So by how much you need to record more asset? 20. Because 80 was already there. So your asset balance will increase by 20. Oh, it's not saying what you will record as asset. What your total asset balance will increase by. So reduce profit by 150 because we need to record 150 expense more and increase non-current asset by 20,000 because 80 was already there. But you need to record a new asset of 100 eliminating 80. So your total asset balance will increase by how much amount? 20,000. It's not asking you what amount you will capitalize. It's saying your assets balance will add up by 20,000 because 80,000 was already there. That you are eliminating. If you don't eliminate, how much your total asset balance will increase by 20,000.
Okay.
Mean in asset, there was development cost of 80,000. Now you need to record a new 100,000. This you need to eliminate, this you need to record. How much is the net effect on total assets? 20,000 more.
But the 20,000, it's a miss here, right?
Yeah, this is not recorded as asset because it's relating to current year, where you will record at the year end.
It's 20,000 is not an asset.
It's spent during the year. It haven't been recorded as asset.
It should not be lost away.
Yeah. If this is meeting development cost, we will add this as a asset and 100 separate will be added as asset. But as the previous 80 is not meeting criteria, so it's going to expense out. And this 20 relating to that, it will also be going to expense out.
Yeah.
I mean, this 20 is I haven't recorded yet. This 20 is haven't recorded yet because this is relating to current year. We need to decide where we should record, either in asset, either in expense. In our asset, what is already 80?
Why are we increasing non-current asset by 20?
In our asset, already 80 is there.
Yes.
But we record this. This we need to record as asset and this we need to eliminate. So what is net effect on total assets? What is net effect on total assets?
Yes, 20.
Instead of eliminating this 80, we will eliminate 80 from this and record remaining 20 of this.
What happened is some project A, B, C, they're different.
But it's for the same business. What is net effect on your total assets?
No, I
Suppose your total assets are of, say, I can say 200,000. In this 200,000, 80,000 is the development cost and 120,000 is say PPE. Now you need to eliminate this and instead of this, you need to record this. If you eliminate this, instead of this, you will record this. What is the total effect on your total assets? 20,000 more. That 80 you have eliminated, 100 you have put it as asset. So what increase in your total assets? Instead of 200,000 before, now it is becoming 220. Technical. So let's have a break. After break, we will start a new chapter. And please inform me we need to start recording again.